Monday, the 8th of August, and the year is 2011. This will be a video on the Dow Jones using multiple time frames. I'd like to remind you I'm not a financial advisor, more like a chartist or a mathematician, and officially I'm neither of them. But I'm just some guy behind a computer who's going to look at these. I made this spreadsheet that can make charts like this with these nice little bands. I got an 18 period average, but it's a front weighted one. I think they work better than the simple or the EMA moving average, the exponential one. I like this one better. And it's got automated Fibonacci. It goes through the last 67 periods, and it finds the high, it finds the low, then it makes the Fibonacci. It's from the highs of about 12,800, and we closed at the lows of the day, 10,810. And the Fibonacci numbers, they're good in this case when you're in a downtrend. If you ever do get any type of bounce, then you would expect it to be areas where you may encounter an area for resistance. Right now, the market's capitulating further. As the market goes lower, these bands will also move lower within it. And the market is extremely oversold because this band here, I like this band because what it tells me is if it's above or below it, this gives you the warning signs needed for major spikes or major crashes. And on the downside, it's crashes. And you had support here, you dip below it in here, you held it here, and another dip below it. So therefore, this has just happened. It means that Tuesday is going to be a major wild day. While Ben Bernanke will be speaking, that's going to make it regardless anyway. And it could mean further downside, but then at some point it's going to have to bottom. And I say this because when you're below this line and you're just capitulating down to the downside, the movements that occur within a 10-minute period or a 30-minute period are just are huge. And the more you capitulate, the more wild the moves would become. We're going to look at this at multiple time frames. So we'll now switch this onto the weekly chart. What we can see in here is that it's now coming down to the lower end of this band. It's at 10,641, so it's not too far from it. It's also near the Fibonacci line, which is 10,749. There was a significant Fibonacci level in here that was not found as support on the weekly time frame. Just because you're at an area where you're supposed to, it doesn't mean that it will. But like I said, you're at the band here. It's an area where it can be oversold and you can get a bounce. But what did the daily chart do? It just kept going below. And I don't want to say like it's going to go lower because it can. I do expect it to bounce soon. As somebody who likes to look for vulture type of steals, which means once a stock or a chart has been down so much, you just feel so obligated to buy. Those periods are going to come in, and that's going to drive the market higher. But that can only do so much because let's assume that it keeps on going down to 10,280. Okay, so now it comes up and it bounces up to 11,450. Then what? Is that going to spell a lower high and then continue a bear market? Because that's normally how it's going to come into play. It's probably not going to follow it all at once, but because we've seen on the daily chart that this band is it's going big to the downside. It's below it. We do have to watch out. We really are going from yellow alert to red alert the way things are going right now. As far as the monthly term time frame is concerned, we have this Fibonacci mark down at about 10,516. This calculates the highs of 14,000 and the lows of 6,500 in here. So therefore, what's happened is we've already confirmed that we're going to 14,000. That's already happened. Why did we confirm that? Because we came up to this resistance point a few years or two ago. We found resistance, we stabilized at the 18-period average, and we broke through it. Now we need to confirm and hold and stay above there for a while. That has happened. However, because the market did not find support where it's supposed to, and where it's supposed to is either this moving average in here, even the previous resistance line, then you almost got to consider this to be a possible failed move. The failed move in getting above this significant Fibonacci level here and not making it to at least its previous high of 14,000. But then again, you say, oh, so does that mean it's for sure going lower? No, because there can very easily become a failed move that might bring the market down to this band. and then back higher, and then that would be a failed move in itself. Very oftentimes when you're keying or eyeing in on a failed move, you want to be very careful, because if you're expecting one fast move to come in an opposite direction, you could be faced with even yet a bigger failed move that would result in a more bigger failed move. Let me explain that a little bit better. Say, for example, you're here, okay, you're saying, okay, man, this looks like a failed move. I really want to short this thing. Okay, so you're shorting it, and it goes down, and next thing you know, boom, it pops back higher. Now is this move below going to be the failure? And then you'd be looking for that fast move, and most likely it would be not only the 14,000 level, but upwards to 16,000. Of course, this is long-term thinking, but the longer these charts go out, then the more long-term you would want to be thinking. Right now, for the month, the stock market is down over 1,300 points, or 11%. So it has been taking a big hit, but we see here, this is the first significant red candle here, sort of like this was a significant one back in there. As far as the quarterly chart is concerned, each one representing 3 months worth of data. Right now it is down 1,600 or 13% for the quarter, and it's now moving towards this 18 period average of closes, and that level is at 10,800, so it pretty much bottomed right at the level for today. We're seeing this chart, and we have a situation where you make this low, and then you make this high, which is a higher high, and now we make a lower low, and now what's the question? Are we going to make a higher high or a lower low? Generally speaking, when a market goes from higher high to lower low, then it can be very neutral or very tough to decide. And we do have a situation within this moving average now that has above it, below it, above it, below it, above it. When it just keeps going back and forth, that shows a lot of indecision within this market. And that's been the case. It's almost like a silent crash, because even though this market's gone mostly sideways for the entire decade plus, but inflation has eaten away at your profits. If you bought in here at say 10,300, you're not up 5%, because the average product is up and service is up well more than that. So it's been a more of a tougher loss when you consider it within that direction. Now we'll now move this on to even a much more longer term chart, because what I see here is I see a head and shoulders pattern, and I need to see more data. So we'll take a look at the yearly chart. And what we have within this is we have this high that comes back to the 18 average band. Then we make this another little bit here. It comes back to the band and breaks below it, but then recaptures its band. It has been trying to get above it, but it hasn't. It's still within the band. The 18-year average of closes is currently right now at 10,527. This is front weighted, and what would be a concern is when you have a situation where you find support of this moving average and you make this high. Now it is a higher high, but mathematically barely. And then you throw the inflation factor in, then it might be even a lower high. And then you make this low in here. You're really seeing a lot of warning signals, because it looks like this average wants to start to flatten out and go lower. Now you can say this shouldn't matter. This is a long-term yearly chart, all the inflation, it's all mumbo jumbo, and maybe you might be right, but at the same point, if these charts have shown in here that it can collectively go sideways, then this could be the same sort of deal, because that head and shoulders breakdown, if we take a length of the neckline to the top part of this, and that gives us an area pretty much down to the 5,000 mark. That's a pretty significant level, but if we look at where 5,000 is, it's above this band here, which is 4,500. And when you have a situation where you're having the stock market going down and you have people waking up to how currency and how dollars are created, and then they want to say, hey, wait a second, so if dollars are created out of debt and they are, that's another word for it, they're created out of debt and they got no intrinsic value, then where are my dollars? Well, if you have cash in your, we'll just say under the mattress in any form, well, then to get rid of that, you just spend it. But when you have cash as far as any type of stocks, then the only way you can sell the stock is for cash. So people will say to themselves, maybe I should sell stocks just to get out of currency, and thus that will take place. You're also in the situation with the major selling by fear. Now, as far as indicators, what I like to use is an indicator called the direction from the 50-day high or 50-day low. I'm going to put the one from the 50-day high. When this chart goes really high, that means the markets are selling off and they are well above their highest point in the last 50 days. This occurred back in the 2008-2009 crises. Currently, right now, it's at about 18%, a level that it's seen last year during the flash crash level. So we've already reached the amount of losses from that year. We have not reached the amount of losses from in here. And we also matched the 2007 start. And that's something that may occur, as we might even just make this high and go lower and then go back higher again. But maybe we made this high here and went lower. And this could be like this. Maybe we come back down and then boom. I don't know. And again, maybe because people find out how currency is created, we get inflation so bad, maybe nominally the stock market will go higher. I don't know for sure, nor for the most part do I really care. But I do realize what the charts are telling me. And I look at this, I compare this to the 1930s, and the chart was much, much different back then. We're up at 18%. This is the level we're at now. So in 1929, I got up here, and then twice, 3, 4, 5, 6. It was a lot worse back then than it is today. But it's good to know that stuff like this has taken place before in the past, and that there is room for further downside. We see here on the monthly chart that it has 3 small candles down and 1 big red candle, and we look back at the daily chart, it had the similar sort of thing where it had like small bits here and then a nice size move down, and then next thing you know, it was going down a lot further. Again, these things do bounce at some point, but it is very difficult to determine when. And when emotion is rampant in the market, things can really go nuts. So thank you for tuning in and have yourself a magnificent day. Bye-bye.